The silver market just witnessed one of the most dramatic collapses in modern history. And if you're holding silver or thinking about investing, you need to understand exactly what happened and what's coming next. What we saw in late January wasn't just a correction, it was a calculated sequence of events that wiped out nearly 30% of silver's value in a single day, the biggest one-day drop since 1980. Today we're going to break down whether this was market manipulation, what role the CME played, and most importantly, where silver is headed from here. Let's start with the facts. Silver did something extraordinary in January. For the first time in history, the metal breached the $100 per ounce level. This wasn't just a psychological milestone. It represented a culmination of years of supply deficits, massive investment inflows, and growing safe haven demand as confidence in traditional assets weakened. Investors around the world were piling into silver. Exchange-traded products held over 1.31 billion ounces, and the market was running a structural deficit for the sixth consecutive year at 67 million ounces. Everything seemed to be pointing toward even higher prices. Then came the crash. In what can only be described as a bloodbath, silver lost almost 30% of its value in a single trading session. To put this in perspective, this was the most severe one-day decline since the Hunt brothers' silver manipulation ended in 1980. Billions of dollars in value evaporated, leveraged traders were completely destroyed, margin calls flooded in, and the entire precious metals community was left asking one question: what just happened? The answer lies in a combination of two critical factors. First, the Chicago Mercantile Exchange, the CME, made a decision that changed everything. They announced significant increases to margin requirements for silver futures contracts. Now, for those unfamiliar with how commodity trading works, margin is essentially the amount of money you need to put down to control a futures contract. When the CME raises margin requirements, it means traders need more cash to maintain their positions. If they can't meet these requirements, their positions get liquidated automatically. The timing of this margin hike was devastating. Silver had just hit all-time highs, which means an enormous amount of speculative capital had flooded into the market. Many of these traders were highly leveraged, meaning they were controlling large positions with relatively small amounts of actual capital. When the CME announced the margin increase, these traders faced a choice: either deposit significantly more cash immediately or have their positions forcibly closed. Most couldn't come up with the cash fast enough. What happened next was a cascade of forced selling. As leveraged positions were liquidated, it created massive selling pressure that drove prices lower. As prices fell, it triggered more margin calls on other traders, leading to more forced liquidation, which pushed prices even lower. This vicious cycle is what's known as a margin spiral, and it's one of the most destructive forces in commodity markets. Within hours, silver had plummeted from over $100 to the low 70s. But the margin hike wasn't the only catalyst. The second factor was a political appointment that sent shockwaves through financial markets. The nomination of Kevin Warsh as the next Federal Reserve Chair created immediate uncertainty about monetary policy direction. Markets interpreted this as a potential shift toward tighter monetary conditions, which is typically bearish for precious metals. The combination of the CME margin hike and the Warsh nomination created a perfect storm that obliterated silver's rally. Now here's where the manipulation question comes in. Was this a coordinated effort to crush the silver market, or was it simply the CME doing its job to maintain market stability? The truth is probably somewhere in between, and understanding this nuance is crucial for anyone involved in precious metals. The CME will tell you that margin increases are a standard risk management tool. When volatility spikes and prices move dramatically, they argue that higher margins are necessary to ensure the financial integrity of the market and protect against counterparty default. From their perspective, silver had become dangerously overbought. Speculation had reached extreme levels, and the risk of a disorderly market was high. By raising margins, they claim they were simply preventing a larger catastrophe. But critics see it very differently. They point out that the timing of margin hikes often seems designed to break rallies in precious metals. They note that the CME has repeatedly intervened in silver markets at crucial moments, always on the side of dampening price increases rather than supporting them. They argue that large institutions with short positions benefit enormously from these interventions, and that the CME's actions effectively bail out these players at the expense of smaller speculators and retail investors. The historical precedent is hard to ignore. The silver market has a long history of controversial interventions. The Hunt brothers episode of 1980, which we mentioned earlier, ended with regulatory changes and margin hikes that collapsed that rally as well. In 2011, when silver approached $50, the CME raised margins multiple times in a matter of weeks, helping to end that bull run. And now in 2026, we've seen it happen again. The pattern is unmistakable, and it's why many in the precious metals community view these actions with deep suspicion. Whether you call it manipulation or market regulation, ultimately depends on your perspective. What we can say with certainty is that the CME's actions had a profound and immediate impact on silver prices, and that impact disproportionately hurt leveraged speculators while potentially benefiting those with short positions or those able to buy at depressed prices. So where does that leave us now? As of today, February 15th, silver is trading around $78.90 per ounce, up nearly 5% on the day. That's a gain of $3.74, showing that the metal is attempting to recover from the carnage. Just a few days ago, on February 11th, silver reached $84.72, climbing almost 5% in a single session. The market is clearly volatile, but it's also showing resilience. The question everyone wants answered is what happens next? To figure this out, we need to look at both the fundamental and technical picture. Let's start with the fundamentals, because they remain remarkably strong despite the recent price action. First and foremost, the supply deficit situation hasn't changed. The silver market is expected to remain in deficit for a sixth consecutive year in 2026, with a shortfall of 67 million ounces. This means that global demand for silver exceeds mine production and recycling by a significant margin. These deficits have been accumulating year after year, drawing down available above-ground inventories. Eventually, this structural imbalance has to resolve itself through higher prices, because that's how commodity markets work. Second, the fundamental drivers of silver demand remain intact. Industrial demand, particularly from solar panels and electric vehicle production, continues to consume massive quantities of silver. While it's true that extremely high prices will eventually lead some manufacturers to optimize their silver usage or seek substitutes, this process takes time. In the near term, industrial demand remains robust. Third, investment demand is still strong. Yes, some speculative excess was washed out of the market during the crash, but that's actually healthy in the long run. What remains is a more solid base of investment demand driven by genuine concerns about currency debasement, geopolitical instability, and the search for safe haven assets. Recent disappointing U.S. economic data and deteriorating confidence in traditional assets continue to support this safe haven bid for precious metals. The technical picture is more mixed. Silver is clearly under short-term pressure as the market digests the violent sell-off and traders remain nervous about further volatility. Support levels around $75 to $80 are being tested, and how the metal performs at these levels will be crucial. If silver can hold above 75 and build a base, it would be a bullish sign. If it breaks below 75, we could see a retest of lower levels. Resistance is now stacked up near the recent highs. The all-time peak above $100 represents major psychological resistance, and the recent high of $84.72 is another key level to watch. For silver to resume its uptrend, it will need to reclaim these levels with conviction, which will require renewed buying interest and, crucially, the confidence that the CME won't intervene again. This brings us to the forecasts. Major investment banks are still calling for higher silver prices despite the recent turmoil. UBS has put out a forecast that's particularly interesting. They expect silver to return to the $100 threshold as soon as next month, driven by the underlying supply-demand fundamentals we discussed. However, they also predict that after reaching 100, silver will fall back to around $85 by year-end. This suggests they see continued volatility rather than a smooth uptrend. The macro environment will play a crucial role in determining silver's direction. Upcoming economic data, particularly inflation reports like the Consumer Price Index, will heavily influence precious metals. If inflation remains sticky or reaccelerates, it will support higher gold and silver prices. If inflation continues to moderate, it could take some pressure off the metals. The Federal Reserve's policy stance under new leadership will also be critical. Any hints of rate cuts or a return to easier monetary policy would be bullish for silver. Geopolitical factors shouldn't be ignored either. Global instability, trade tensions, and concerns about the US dollar's reserve currency status all contribute to safe haven demand for precious metals. These factors don't disappear just because of a technical sell-off, and they could provide a floor under prices. For those considering whether to buy, sell, or hold silver at current levels, the answer depends entirely on your time frame and risk tolerance. If you're a short-term trader, this market is extremely dangerous right now. The volatility is off the charts, and the risk of further CME intervention or unexpected policy changes is real. Technical traders should wait for clearer signals and confirmed support levels before taking positions. For long-term investors and those buying physical silver, the current pullback might actually represent an opportunity. The fundamentals supporting higher silver prices over the next several years remain intact. 6 consecutive years of supply deficits don't resolve themselves overnight. The energy transition and electrification trends that drive industrial silver demand are multi-decade themes, and the monetary debasement concerns that drive investment demand aren't going away. If you believe in the long-term case for silver and can tolerate volatility, buying on weakness has historically been a sound strategy. However, and this is crucial, anyone investing in silver right now needs to learn from what just happened. Leverage is incredibly dangerous in this market. The traders who got completely wiped out weren't necessarily wrong about silver's long-term direction. They were just over-leveraged and couldn't survive the volatility. If you're going to invest in silver, do it with capital you can afford to hold through drawdowns. Don't use excessive leverage. Don't assume that prices can only go up, and always have a plan for managing risk. The manipulation question will continue to be debated. What's undeniable is that the silver market is subject to intervention by regulators and exchanges in ways that can dramatically impact prices. Whether you view this as necessary market oversight or coordinated manipulation, the practical reality is the same. You need to account for this risk in your investment approach. Building positions gradually, maintaining discipline, and avoiding the temptation to chase prices with leverage are essential survival skills in the silver market. Looking ahead to the rest of 2026, expect continued volatility. Silver could absolutely return to $100 or higher if the fundamental drivers reassert themselves in speculative interest returns. But the path won't be smooth, and there will likely be sharp pullbacks along the way. The key levels to watch are $75 on the downside and $85 to $100 on the upside. How silver behaves at these levels will tell us a lot about the strength of underlying demand and the willingness of investors to step back into the market after the recent trauma. The silver story is far from over. The historic crash of late January will be remembered as one of the most dramatic episodes in precious metals history, but it doesn't change the underlying supply-demand dynamics that have been building for years. What it does change is the level of caution and respect that investors need to bring to this market. Silver remains one of the most compelling investment themes for the 2020s, but it's also one of the most volatile and unpredictable. Approach it with your eyes wide open, manage your risk carefully, and remember that in markets as manipulated or regulated as silver, depending on your perspective, anything can happen.